Chad
I
Musgrove,
like it.
my buddy. You're senior vice president of M&T Realty Capital Corporation. I've known you for a while. We met on the conference circuit years ago through a colleague of mine and a mutual friend of ours, Courtney Newmans. Courtney knows everybody everywhere. I've ever been with him. So he's a great networker, connects people. I think probably half the people on this podcast in some way have a Courtney Newman's relationship. So he's brought you and me together here today to put out a podcast episode, which we'll see how it stacks up against Courtney's. I'm sure you're a smart fella. So, and we have some fun topics today too. Doom and Gloom, is that the name of the episode? No, this is
Hey
good.
man, listen, I don't know if we want to make it that, but listen, I think the marketplace is it's a very unique time and a unique position, right? And I don't think it's all doom and gloom. You're still seeing a ton of transactions take place, and at the end of the day, right, people are in this business because they think they know what they're doing when it comes to real estate, right? And a majority of the professionals and transactions that you see take place, or I won't say a majority, but I'll say a good fair amount of them are people who have been in this business for a while, right? And this business happens in cycles, so we're at a different point in the cycle, and that's it. And there will be some losers, because in order for someone to lose, someone else has to win, right? So if you're taking that in the literal sense, it can mean that someone effectively loses capital in a transaction, or it could be in the sense that, someone sold a deal, made some money, and they feel like they lost because the next guy sold it for a higher price.
Yep.
Right? But is that a bad thing?
Yeah, it depends on which side of the transaction you're on, right? And yeah, it's we at the Lemoyne Capital, so plugged into what's going on. This is both of us live in the lending world. It's our day job, so constantly plugged in, trying to read the tea leaves on what's going to happen 12, 36 months down the road. It's like choppy waters. I think the general sentiment I get from talking with people out on the road, executive leadership here at our company, is that there's, rocky waters are here. And like you said, there are going to be some winners and losers. And what do you think? What do you think one of the first things to crack is? Is it lenders who have had, a little too aggressive LTVs, LTCs? What do you think the first chink in the armor is going to be related to our space on the kind of non-owner occupied investment lending side?
Well, I mean, look, it's a couple things, right? Let's think about it in this perspective. When the lender made that loan, was that loan too aggressive at that time? Right? Was the LTV, too high at that time? I mean, we got to understand valuations are where they are in the marketplace because someone truly believes that that's the value, right? When it comes down to a purchase, you're willing to purchase an asset because you believe in that price. You believe you can, add value to it and further, create or enhance the subject property in some way that's going to then allow you to achieve an even higher valuation. So you can't say for certain that the lender was wrong to provide X LTV on this transaction, because the fundamentals, or we would assume one, right, that they have fundamentals, and that their analysis was evidence based. Right? Did Dalton purchase the property down the street for the same amount of money? Did Courtney purchase the next property down the street for a similar amount of money?
Yeah.
Right? Is there capital still flowing into that specific area of business? Are jobs being created? Both of us are in the multifamily space, right? So are there safe schools nearby? Where are the grocery stores? Essentially all the market drivers that you think of that makes a community great. Yeah. Right? Or at the same token, typically people are looking for value, so they're going into markets that may, quote unquote, be on the fringe, or, be tertiary or secondary, but they've got some demand drivers which have people thinking that, hey, this is going to be a market that may change in the near future, and I'm going to realize, a certain return for my equity. So this is why I'm investing here. So to say that a lender made the wrong choice, my question that I have to ask to that is, well, why did they make that decision?
Right.
Again, was it evidence based? What else did they see? Is there analysis rooted in the data? That I can't really say.
Yeah. Yeah. It's, I think the only certain thing is it's going to be interesting, and there's going to be a lot of curveballs the next 6, 12, 18 months. Uh, let's bounce from fun topic to fun topic. Inflation. You and I were chatting about that a little bit beforehand. I'm understanding. I'm 29 years old. I'm understanding that I didn't fully appreciate, and I don't think I do at this point, but I didn't really appreciate inflation up until this point in my life, because there has not been much inflation to appreciate. And oh my, there's plenty of it right now. So
Yeah,
what in the world is going on? How does
everything's a
that
little
affect our
expensive,
space?
man.
Yes. And if
I,
you can get some stuff, right, you still have supply chain issues with everything. So not only is it hard to find something, even if you have the cash and want to buy it, but then it's more expensive, way more expensive. So what
yeah.
in the world, Chad? Fix this.
I mean, listen. If I had the secret sauce, dog, now I don't think we'd be sitting here on this podcast. We'd probably be taking my butt out somewhere down to the Keys. It'd be a different conversation, right? But I mean, look. The bottom line, right? Too much capital chasing too few goods and services, you're going to have inflation.
Mm-hmm.
So when you couple that with a pandemic that had taken place, and by some measure, people still argue that we're quote unquote may still be in it or at the tail end of it. You had the reduction in the supply chain. You had businesses closed. You had some businesses that went away. So inherently, inflation is just going to be higher because not only is there a limited supply of those goods, there's a limited number, and or should I back up and say that there's fewer actual suppliers in the marketplace, right? So that just makes for this perfect storm that you're seeing today. So I mean, look, to have a crystal ball and say when will the inflation end? I mean, is it going to come from the Fed continuing to push rates? Is it going to be at some point once businesses are either able to optimize in a fashion to keep up with demand, or do they open up production elsewhere? Those things we can't answer. We can continue to look at sales and services of different businesses and see what they're doing to catch up. But I think inflation is just going to be here a while to stay. Your gas is going to cost a little bit more. Your groceries are going to be a little more expensive. Hopefully, your Wi-Fi bill isn't going up too much. But look, I mean, again, that's a part of the cycle, right? That's kind of how the cycle in this business goes. And when inflation creeps up, which is why you tend to see people seek out real estate in order to hedge their bets against it. Now, at the same token, one would also argue that if you're someone who supports free markets and no hand control in the marketplace, do you say, hey, let's just back up and leave it alone? Or do you say we intervene because at the same time we intervened when there was a pandemic, and before that when there was a great recession, to artificially reduce rates to stimulate business, and now we're essentially just at the end result of that. You got to remember, in this business everything's always lagging.
Yeah.
Something you do a couple years before is now going to take effect and be here today. And I think that's true in the sense of what we're seeing now.
Yeah. From an operator standpoint, right, is the best thing an operator can do right now, if you have some type of value add project or new construction, is it just buy as much of what you need as early in the process as you can, because the smart money is probably on, a continued supply constraint and continued inflation. At least, you probably see that through the balance of this year.
I mean, listen. At the end of the day, you got to still be a betting man on that one, right?
Yeah.
Think about it. The price of lumber came down a little bit from where it was, still high historically. If you expect the supply chain to open back up, then no, you're not going to go out and go buy, a wealth of items and put them in some storage and wait to use them. But if you still have real concerns about that being the case, and or you have a bead on specific materials that may still be hard to find, depending on your business, then yeah, you buy them. So I mean, I think the pendulum can swing either way to the question.
Yeah.
But at the end of the day as well too, what you also have to consider is speed of execution.
Right.
Speed of execution, and not only delivering your product, but speed of execution and saying that once I deliver, now how am I going to drive a capital event to return the equity to myself or my investors?
Mm-hmm.
Right. So are you focused on simply just executing at, now numbers and costs, and you couple that with rising interest rates and you let the cards fall where they may be? Or do you say, hey, you know what? We expect things to open up a little bit. Folks are going back to work. Production's going to increase some. And, we're just going to have to kind of take our bets with where interest rates may be. Because in the foreseeable near term, there's an expectation that rates will continue to rise, at least another 75 bips from the Fed. So what you have to, I think the question is twofold, because you have to consider that coupled with your earlier question in that, the lenders, overextend themselves, etc. And the reason why my answer was what it was, because as rates rise, we all know what's going to happen. I mean, it's a function of the math. You're only going to be able to borrow so much money as interest rates rise. So it's really, I don't think there's one quick solution for it. I think it's more so, do you want the chicken or do you want the egg? Right? So
Yeah, it's just our conversation is indicative of the time, right? Like it's just such a guessing game. I think the one thing I come back to when I go down that pathway of real estate guessing game is that like there's such a supply imbalance, right? Like we're still way behind the 8 ball on just housing supply, and that's not something that's going away and normalizing in the next 6, 12 months, maybe 18 months from now, just depending on how everything goes. But that's a relatively deep medium term problem that's being worked on, and that's something that I look to as kind of a beacon of light through everything else. You have inflation, you have supply chain issues, go on down the line. Those things, but in terms of tailwinds for the industry, that supply issue, which just naturally happened because of underbuilding post Great Recession. Right? You just had a snap back to new construction that just had stopped, and then it was a slow creep back up. And I think whenever we hit the pandemic, we were still below, pre 08 building levels, and it's just a supply issue just hasn't gone away. So when I look at that, it's like you have a supply demand imbalance, which from a housing health standpoint isn't, it's not problematic. And you would argue from a lender standpoint and from an operator standpoint, like that creates opportunity. So that's one thing I look to as, a positive tailwind, and it's a, mutually beneficial thing for everyone, right? The more renovation and creation we have around housing, the more opportunity you have for renters, owner occupants, investors, all down the line.
yeah, no, 100%. I mean, look, man, when one thing you specifically said, which was very important, right, that we've underbuilt for some time now. I'd honestly have to go back to check the statistic to make sure that I'm 100% accurate. But, last I looked, I mean, we were talking, 6-7 million units that we were short of, quote unquote, affordable housing.
Yeah.
Right. And we're talking about someone just simply not having to pay 50%, of their monthly income towards their rent. think about that number, 50% of what you take home to simply go to one expense.
Yeah,
Right. So
it's
you couple
crushing.
that with inflation, you couple that with supply chain and other issues. So now as an operator, I really think that, we're going to be in a period and we're moving towards a period in a time where, the really good operators are going to be the ones who are going to be successful because they can do that further calculation to say, okay, well, this person's already spending 50% of their income on their rent. Now what happens, when their gas is up, 40%? What happens when their groceries are up, 15%? And how can I still incrementally, create some type of values? And so now maybe your rents don't move, $150, right? Maybe they only move $60, or something like that. And so again, I think you're moving into that period where really being an operator is going to be, very important versus having a, blanket solution to saying, okay, at, all of my properties, we're going to, reduce rental rates by 10%,
Mhm.
right? That may not work for a certain market where, the tenants at your property spend an hour and 20 minutes commuting both ways,
Yeah,
right? That may work at, a property where someone's hopping on the train or using public transportation just because, their transit card is 10 or 15% more expensive. But, if that person's got to get in the car, drive an hour to get to work a day, they got to drop their kid off at daycare. They still got to get groceries. They still got to go pick up medication or they still got to run to a doctor's appointment, etc. These are real life experiences that are now becoming a bit more, cumbersome, um, just because you simply got to factor in how much more money you're spending on gas,
yeah,
or you got to factor in how much more money you're spending on food. So I mean, yeah, I think we're at an interesting time in the marketplace where, I mean, look, deals are still getting done. There are lenders out there that still will make transactions happen, and the question then becomes though, does the fundamental underwriting coupled with the pricing allow you to borrow the money that you need in order to execute your returns for your investors? So, dog, I may not be able to pay you that, 20% return or 16% return. You might get a 10 now or, an 8. I might only pay you, 3% cash on cash.
Chad.
Right. So then what happens to that investor that says, hey, I'm not an operator, I was just looking to get this return, but now I can go get that, in some other asset class.
Yeah.
Right. So, going to be challenges for sure. But again, I think that goes back to, where you're the owner operator, you really got to find now that fine balance to executing a business plan and making sure it's successful for your investors.
Yeah, just have to be more careful than ever before. You and I were at a conference a couple months ago in Texas, and that was a big topic on the panel of like you need to have, you can't have loose
Yeah,
assumptions there, right? Like now is the time that you need to really stress test every deal using some unfavorable assumptions because there's a decent chance that those unfavorable assumptions pan out, and you do not want to be underwriting, for your own potential
100%.
deal, like just this cushy cozy, everything's going to keep going like it has gone the last 24 months because that is absolutely, I mean, look at, it makes me sick to my stomach. Look at the market. Look at, I give plenty of red everywhere. It's like this is different from the last couple of years, and so to keep your assumptions fixed from 2020, 2021, 2022. It's just far too dynamic of a world right now. Far too much uncertainty that being on the conservative side is absolutely 100% the way to go.
Yeah, well, I mean, look, I think one thing we can be certain about, right? Interest rates are up.
Yep.
They're up from where they were. That being said, they still are lower than where they've been, historically, right? I've been in this business over a decade now. So, having seen things kind of come full circle, I mean, look, today in the agency world, right? I mean, we're quoting deals anywhere from the low to mid fives,
Mm-hmm.
depending on product type, size, deal, location, etc. Depending on leverage, that's higher leverage, I would say, if you can get 70, 75% today.
Yeah.
But depending upon leverage, lower leverage could be a little bit cheaper than that, but that's a far cry away when the 10-year treasury is hovering around 3.3%, been up to 3.4, 3.5. That's a far cry away from the days where we were at a 2.5% 10-year treasury.
Yeah.
So when you do the fundamental underwriting of transactions, I think the key and most important part, right, is to really figure out how you model out the exit structure. Because if I'm telling you that, I mean, look, even one of the longest term, cheapest financing tools, right, the HUD 223F refinance product, 80% leverage refinance product, you can quote a deal today at 475 for that.
Yeah.
That may sound relatively cheap to a Fannie Mae execution that's at 5.3, 5.5%, right? But still a little bit higher than what things have been historically. So it's going to come down to you, coming up with essentially a return solution for your investors and saying, okay, are we comfortable with, taking 35 years of loan term, but it's going to take us, longer than 60 days to close a deal.
Yeah.
Right. So, I mean, that, part of that reason was actually, in my recent job change, why I made that move. I mean, it's you want to have, multiple tools and weapons for your clients and be able to really give them a full service approach. Right. Because in turn, they've got to do the same thing for their investors. So when you really look at the overall marketplace, right, it's really just figuring out how to be service driven and say, hey, here's how we're going to execute today. This is what we're going to do to combat inflation. This is what we're going to do to combat, rising rates. And then it also comes down to what marketplace you're going to play in, right?
Yeah. Yeah. Product development during these times is always very different than product development, a year ago, whenever, HPA was just up and to the right. It's like you could, as an operator, like you could be a little bull in a china shop with assumptions and plowing through, and like you'll be okay. Like HPA is going to save your
That's it.
tail.
That's it.
Uh, Banking on that now is becoming more and more perilous. So, but yeah, like still no shortage of opportunity. American housing is strong, and when you think back to the last drop off, like you had the core issues of fraud, misrepresentation, things that just had at the time an unhealthy, although we didn't realize it in a lot of ways, housing market. And like housing market's strong now,
Yeah.
and so there's just some normalization that's going to happen. Like you said, one thing I like to remind our sales team about here at Lima One is that, even relative to when I got here, this month is 7 years at the firm for me, and I started underwriting 30-year debt for our rental product. I was doing loans at 8.5, close to 9% for 30-year fixed
Yeah.
SFRs, and people, like, we were growing as a company rapidly at that pace. People would give it to me, and yeah, when you look at rates through the historical lens, you're like, we're fine right now. We're fine. So yeah, I think ending on that truly positive but very real and factual note. That's what we're going to do. We started with some smiles. We're going to end with some smiles. Chad Musgrove, hey, congrats
Hey, man.
congrats on the new role, by the way, over at M&T Realty
Thank you.
Capital. Very happy for you. Can't wait to see you out on the road again. I know you're a busy family man too, so you're always holding down the fort there. So thank you, with everything you have going on in your life. Thank you so much for sitting down and taking some time with me, my friend.
Well, Dalton, I appreciate you having me, man, and it's truly an honor. Love what you and the Lima folks are doing over there. Love the entire team from the top down, right? So you guys are really doing something special, and you've grown a great company. So always good to be in the presence of greatness and good company like yourself, man. So anytime, hopefully you'll have me back.
100%. You are the man. Chad, thank you so much for joining. And thanks everybody for listening. Take care.
All right, take care.